to the computer. Hey everyone, welcome to yet another Viterbi Startup Garage Oceanside chat. We've had many of these last year, basically ever since we went virtual, and we're kicking off 2021 with yet another one. We brought Brian Horner in. Just a little bit about him. He is the managing partner of Ladder Ventures, which is a seed stage venture fund based in LA. He also is the president of, he's a current president of Tech Host Angels LA. And in case you guys don't know, it's an angel fund. They invest on average about 15 to 20 million annually on about 50 to 60 teams or companies. He's also an acting advisor for several of those portfolio companies. Fundraising, finance, strategy, and corporate development are ways that he advises. And as if he's not busy enough doing all of that, he's an adjunct faculty member at UCLA, doing MBA course instruction in both business creation and strategic management. He has 10 years prior to all of this in investment banking in New York, which is, pretty intense. And finally, he studied economics and business management at Bucknell University, and he received his MBA at UCLA, which makes sense why you're back there now, giving back to that program. Anyways, without further ado, I'm going to let you introduce yourself further at length if you'd like, but we're really excited to have you here. Thanks for being here, Brian.
Hey guys, how are you? I don't really have much of an agenda, so most of this we could do just sort of Q&A, but I'll give you, she did a great job about my background. So I'm currently with two firms, Tech Host Angels, I've been the president of for a year, and I've been a member for 5 years, and we're kind of looking at the same stuff that Ladder Ventures is looking at, but basically seed stage companies, industry agnostic, and true industry agnostic. A lot of VCs will say they're industry agnostic and won't do hardware, won't do deep tech, won't do healthcare. TCA really does do everything. And we look for, any startup with a little bit of traction, really solid teams. And we, take cold emails. We, screen a lot. We screen about 8 companies a month live with investors, and even more so kind of we pre-screen and call. So, happy to go through the process, but basically it's like a 30-day process from start to finish. We recently launched a fund within Tech Host Angels. Some feedback we were getting from entrepreneurs was that, they didn't want to go through a long due diligence process and not know how much money was coming at the end. Was one angel going to write a $25,000 check, or are you going to get, 40 angels, trying to write $1 million worth? So the fund, we now have a fund where our second fund, it's sort of an evergreen fund that we ask members to kind of re-up as we're 80% depleted, and we try to make it kind of an annual basis. But that fund will invest 100 to 200 grand depending on traction and votes to lead sort of the investment, and then individual angels will come on the round as well. So we've had a pretty good year the last 2 years, investing about $20 million a year, up from prior years of 10 to 15. So the fund's actually working. But yeah, I mean, from my standpoint, I'm happy to answer any questions about startups. I'll kind of give you a little bit of kind of lessons I've learned, what's worked and what hasn't worked. I'd also like to invite anyone that wants to sit in on a Tech Host Angel screening, just to kind of sit on the other end of the table. I think it's really informative. If you are, an entrepreneur, to kind of see how investors react to other entrepreneurs' pitches. And to kind of wear the investor hat for a little while, because that sort of helps then craft your pitch to investors going forward. So I think that's actually one of the most constructive things you can do, when you're starting a business, to kind of get kind of a handle of what the audience wants.
Hey Brian, quick question.
Yeah.
Since basically everything's shut down and most things are virtual, do you know when you guys will be doing those screenings again? Are they happening virtually?
They are happening virtually, and actually, I think they might actually stay virtual for the foreseeable future, just because it is a lot easier for people to log on. I don't know if you guys listen to a lot of podcasts, but a lot of venture capitalists are saying that this is actually kind of the best thing to happen for entrepreneurs, and also VCs, because Prior to this, there was sort of a bit of a closed door where if you weren't based in the Bay Area, you couldn't go meet with the entrepreneurs, or the VCs, go have coffee with them. VCs also had a hard time meeting people from other states for the same reason. There was a lot of friction. But now that the Zoom has sort of opened up the world, you can be a lot more efficient with your time. You can meet with 3 entrepreneurs in a 2-hour span over Zoom if you really stack your schedule well. And it's sort of opening the door a lot. And I think it's really been positive for everyone, both from an entrepreneur standpoint. They can reach out to New York VCs, Chicago VCs, Boston VCs from here, and vice versa. So from our standpoint, from Tech Coast Angels, our members have been attending a lot more meetings because they can actually just log on versus having to kind of leave the office and come. We usually do a lot of our screenings at UCLA. We've actually done a few in Marina at USC. We haven't done any recently, but that's a great venue as well. But I think the short answer is we are virtual. We're still meeting twice a month virtually, and we'll probably continue that going forward.
Good to know. Secondarily, before I let you continue, I forgot to do this earlier, and Turaj reminded me, he's one of the Garage teams. Please, you guys, use the chat function to introduce yourself to everyone who's on this call. I think one of the things that Brian is mentioning, which I've recognized, is that Zoom really does allow for kind of a broader network of meeting in one singular space, cross country. And so you don't know who's in this chat. There might be somebody very useful to you in this chat. And so who you are, if you have a business, or if you're a student, what you're interested in, and if there's anything that you need, if you're looking for anything, just add that to the chat. Go for it, Brian. I'm sorry.
Yeah, so I don't know if you want to moderate this. I'm sure I can kind of kick off some sort of questions I usually get all the time and open it up to just general questions. I don't know if you had sort of an agenda, but let me sort of start with the question I get all the time, and it's like, or a couple of questions I get all the time. One question I hear a lot is, how do I position my company to a VC in the sense of market size? And you kind of have two conflicting areas. So one is, if you set the market too big and try to set your company for just sort of this like wide-eyed sort of approach, as a startup, venture capitalists say, all right, I think they're biting off more than they can chew. We know how hard it is to kind of start a business. And when you sort of come in with these grand plans of doing 19 things at once, it sort of sours the taste a little bit in investors' mouths, because they just think it's just not possible realistically for a small business to do that. And then on the other side of the equation, you have, all right, well, if I have a really hyper localized business or hyper focused business, is that enough to kind of get VCs appetites wet, because they just don't see sort of the upside? And and they are conflicting, but there is sort of a common approach. And the best way I could think of an example is sort of like a stair-step approach to kind of how you view your business, and say, look, here we are now. This is phase 1. We're going to go after this market. And then when that works, we're going to shift into phase 2. We're going to shift into phase 3. So what you're doing is two things. One is you're conveying that you have a tackleable problem and market that you can go after right up front. But then you're also sort of incepting in the VC's mind that how this business can grow. You've also shown that you've sort of put in some deliberate thought into how this can grow. If you think of like Jeff Bezos, if he came into his first round and he said, look, I want to build a business that is going to be sell every good you could possibly imagine online. We're also going to be a grocer. We're also going to be the largest cloud storage company in the world. We're also going to have a movie studio and a TV studio. He would be run out of the office. But the way he grew his business was he started with books, and he expanded it to more retail, and then he realized that there was a need for cloud computing, and then with his Prime membership. So I would kind of think in that mindset of, how can I sort of stair step this function up along the way and prove sort of inflection points as I'm raising. That's kind of a good way to kind of meld the small business focus with the large sort of ambition that a lot of VCs look for. Another thing to kind of think about from an entrepreneur standpoint is really, and this is why I kind of tell people to come sit as an investor. You as you are pitching venture capitalists, they have in turn done the same thing. They've done a whole pitch day where they go to LPs and say, hey, here's my fund, here's what I'm going to do. And they have to show performance just like you do. And the way they show performance is really with returns and really sort of having sort of large exits, that will make up for sort of the ones that don't fail. So you really have to, sort of incept on them like this feeling of, okay, there is something here. If I'm not involved in this, I might feel like I'm missing out. There is a lot of upside. So kind of think about how they're viewing, their own success and their own returns for their fund when you're kind of pitching them. Another thing I kind of say is like, when should I approach venture cap? When should I approach VCs? And is it, who should I approach? And the answer is, you should always be sort of talking to the next round or 2 rounds ahead before you meet it. So if you just raised the seed round, now is kind of the time to start your discussions with the Series A folks, because the worst, like there's an old saying that says, if you ask for money, you're going to get advice. And if you ask for advice, you're going to get money. So what I like to kind of tell kind of students at UCLA is like, now is the time to start reaching out to seed investors and not saying, hey, I need money, but saying, hey, look, what do you guys look for in companies when you're investing? What sort of KPIs, what sort of targets should I be thinking about when I'm building this business for the next 6 to 12 months, so that when I am ready to raise, I can come to you and say, hey, I've reached these goals. So it does 2 things. One is you're sort of fitting your business to what they're looking for, which is great. But this sort of ancillary benefit is, once you sort of establish a relationship with someone and they see you grow, they feel a sort of kinship, and they feel a sort of I don't know, like almost like a big brother sort of feeling of like, oh, I want to now help this business. I've seen this business sort of grow, and I want to now sort of support it now that I'm sort of emotionally involved with it. So I see companies that have reach out early tend to have a lot more luck, certainly getting a meeting, certainly getting a pitch, but also sort of closing that meeting, because the VCs can say, oh, look, I've known this person for a while. I've seen them grow. They're good. Versus just sort of like an intro email when you're asking for money. It just seems to work a little bit better. So that's kind of my 2 kind of main things. But I'm happy to talk about pitching and storytelling. But I don't know if you have any questions, Arcelia, or if we can open it up to students.
Let's see. Hold on 1 second. Does anyone have any kind of like mid chat questions? I have a few, but I don't want to hog it if you guys have. So I guess now's a good time if you have a question to turn on your camera. Otherwise, I'm just going to jump in. Hey, Taraj. So my first question is, and then I'll pass it to Taraj, it's just in terms of KPIs. They're tricky. They're tricky to set for yourself because, you don't exactly know where you should focus your attention and what those key performances are. And so from an investor's perspective, an investor perspective, especially like pre-seed or early stage, like what are the metrics that are really important to add to that deck? Like what's going to help you impress an investor in that stage?
So, it really depends on what industry you're in. If you're in a SaaS business, the biggest KPI is churn. Everyone wants to see churn. Are your customers, is your revenue sticky? And really sort of any recurring revenue business is really churn stickiness, because then they can sort of extrapolate out that, okay, there's a certain, in the small, few customers that they're testing this with, it seems to work. And they, now we want to fuel the fire. So the best way to think about your business is if you can sort of set it up to a story that is, it says, look, we're doing well here. We want to expand it. And your money is just going to fuel this fire. The engine is already working. Now we just need to, make it bigger. So think about your business in that sense, from a KPI standpoint of what is working. The other thing is really market size, is huge to say, hey, here's the addressable market. Here's how we're going to do it. And that's sort of key, obviously. One that people talk about, but I don't view as highly, but some people do, is really sort of your customer acquisition cost. And the reason I don't look as in, I don't key in on that too much is it's going to change so much. We recognize that you have 1, 2, possibly 3 employees. It's impossible to be maximizing the efficiency of your customer acquisition costs. So we realize that, hey, our money, our investment is going to bring those economics down. So I really look more for gross, long-term customer value. And to that extent, it's really churn times, revenue. Do I believe that these customers are going to stay on for multiple years? It really is, it becomes just sort of an engine of, okay, the money in is customers acquisition cost, the money out is lifetime value. But it's certainly not a ratio. I mean, everyone says 3-to-1 ratio, but they're going to move so much, that I don't think many seed investors really get too hung up on that, that 3-to-1 ratio. When you start getting into Series A, growth rounds, then they start to really look more in tune on the ratio. But that's kind of another kind of popular one that everyone looks at. But from a seed investor, really the top things that everyone's going to tell you, you probably heard it 1,000 times before, is team. Now, do I trust this person with my money? Are they, number one is always, are they trustworthy? But 2 is, do they have sort of the bandwidth to kind of make this work, and the capacity to make it work? And really 2 is like the market size. Like, if it does work, is there going to be a huge exit for me coming out that is going to make it worth my while? Sorry, turn my phone off here.
I'm going to move it over to Taraj, and then after Taraj, Stacy.
Sure, thank you. So first of all, I really like to participate in one of those sessions. So how would I let you know, through Arcelia or?
Yes, please. Yeah, so you can pass your email along to me, and then we can set you guys up. Set you up, yeah.
Sure. And regarding the growth, is there a specific growth rate that you are looking at, or it depends on the startups and industries?
Look, everyone's going to always say it depends. It depends on a couple things. One is, what's the base it's growing from? 2 is the industry. Look, we're looking at a healthcare company. There's going to be 0 growth, right? And we're looking at very different KPIs. Like, are they able to navigate the grant landscape? Are they able to get free money? How far along in the FDA process are they? Do they have any what sort of patent protections do they have? If they came through a university, what's that licensing look like? So it's very different. Growth, though, is always good to see, to say, hey, look, the businesses that get the most money say, all right, we started here, we've sort of ramped up our advertising. You can see businesses ramped up accordingly. But there's not like a number, like a slope ratio that we look for. It's just sort of, does it look like they are adding, as they start adding money to marketing, it's showing up in sort of the revenues.
Okay, makes sense. Thanks so much.
Sure.
Great, thanks, Taraj. Okay, I'm going to pass it over to Stacy, and then I think Julie's next. Stacy, you're muted.
Sorry, I just realized that. Hi, I'm happy to be here. Thank you so much for setting this up. My question is about valuation, which I think is probably a lot of questions in terms of how do you, there's different rules of thought about it, but just kind of what would be the best answer if you don't really have one yet, especially if it's pre-revenue?
Yeah, so we could do a whole talk on that. It's so difficult because you could go, I see companies that come out of, Pittsburgh or Kansas City with a $2 million, $3 million valuation. And I see companies out of San Francisco with like a $20 million valuation with really the same traction. It's just the companies in SF have, General Catalyst investing and sort of some big names behind them. or they're ex-Googlers or Stanford, like the team. It's really, and like LA somewhere in the middle, New York somewhere in the middle. So it really depends on who you're talking to. From a valuation standpoint in general, though, the one thing I'd be, I'd sort of, the message I would leave with is when you're pitching, the difference between a $6 million valuation and an $8 million valuation and a $4 million valuation is kind of de minimis. If you play out the role of like, okay, we're raising here, what's my dilution, what's my value? Like if you play it out to sort of the end, you're going to see that it really doesn't make too much of a difference for you from a dilution standpoint. I will say this, if the valuation is set too low, this has happened to us, or not, it wasn't set too low, it's just that they raised so much. They recap. We've had rounds where me personally, we were invested in a round. It was a Techstars company that had, I think, a $3 million cap, and they went to a VC, and it was a convertible note. And the VC said, "Look, I want to invest. I want to give you guys, $5 million, but the cap has to come up because it doesn't make sense for you as I don't want to leave the CEOs with this percentage equity in the company." So they went to all investors. They said, "Hey, will you raise the cap? Otherwise, we're not investing." And like to a man, every investor was like, "Of course we will, because we want, this is a great deal. Techstars as well." So people are flexible. The other thing with valuation is if you set it too high, it really could be the end of your company, because there are VCs that will never say this, but they will be in their pitch decks when they're going to LPs, and they'll specifically say, "We don't invest in down rounds." Now they can't say that publicly because it's just bad PR, but a down round really it cuts off probably 2/3 of the funding sources, probably 1/3 just as a rule, and the other third are like, it's just not something we do. So there is a danger in setting it too high. And if you set it at 4, you go up to 8, it shows sort of this nice, it just gives a nice story of growth, versus starting it at 8 and then trying to raise it 8 again. It could be your company right there. From a tip, now I'll kind of give you like a specific answer. Companies that come in with, it's typically like 10x revenue, right? Is sort of kind of the A round that they look for. So, if you start, we'll see companies that have, I don't know, like 25 grand in recurring revenue. When I started, it was like a $2 million, $3 million valuation. Now I'm seeing, 3 to 5, sometimes 6, sometimes 8, depending on the team and the area they're in. I mean, if you're in the EV space, you're going to garner a higher valuation than if you're in, some, I don't even know, like a CPG product or something like that, box, subscription box company or something like that. So it depends on like how good the industry and what the demand is. You can always sort of put a loose kind of target on it. VCs do. It's weird because like when you start getting to growth stages, they start to set the valuation, but in the early stages, you start to set it. But that's to say you should always be flexible. The lead investor will typically sort of say, "Hey, here's what I'm looking for." We do get a lot of problems. I don't want to run on too. Do we have a hard stop on this? I don't want to like run on too much on these answers, but.
Yeah, I think we usually go to about 2, but people definitely stay.
Okay.
I mean, I'm sorry, not 2. We go for an hour, and so we would be stopping at 1:30.
Well, yeah. So this is important to everyone. So I'll just kind of keep running on. For the other thing in valuation that what was I getting at? I kind of lost my train of thought.
That's a tough one. It comes up all the time. And then also during like the pandemic, it's hard because the market changes, everything changes, and it's
yeah. What I was going to say is we've been running into these problems a lot recently. Is that a lot of friends and family rounds are raised with just that, friends and family, where the friends and family have no idea what the valuation should be. So you go to your friends, you say, "Hey, look, this is a $6 million company. We have this idea, you raise, and these rounds are actually getting bigger and bigger. It used to be like $100,000. Now you're seeing some like $400,000, $500,000, $800,000 friends and family rounds at these very high valuations, $8 million. And they come to us with, 10K in MRR, and we're like, we can't give you a $10 million valuation, and I don't think we can give you an 8. And then you get stuck in the situation where the entrepreneur doesn't want to go back and tell their friends and family it was too high and lower them. So they just keep looking, and then they just kind of run out of money. So if you are raising your friends and family around, just be ready to just kind of take the cues from the market that you might actually have to lower that round or give them sort of better terms in retrospect. Don't get too hung up on a valuation that you've sort of set for yourself if a lead investor wants to give you a larger check for a lower number.
Thank you. I appreciate that.
I saw a question from on the chat as well. From, let me see who it was.
Julie.
From Bruel, just how to navigate a typical pitch call.
Sure, we'll get to, I think.
Yeah.
Oh, go ahead, Brawl.
No, so I'm from a robotics background, and when we pitch to a VC, everyone has this broad bandwidth of experience. So, knowing that as a history, how to typically navigate this 30-minute call, where if you ask questions to VCs, you are chewing up 15, 20 minutes just learning about them and not having enough time for us, and vice versa. So any thoughts on that?
Yeah, I wouldn't chew up too much time asking them questions. Your goal at the end of the call is for them to come away with enough information that they want to follow up with you. And, I know that a lot of people say always be the one interviewing, but, rather than getting interviewed, but that doesn't work in this case. So yeah, look, it's fair to ask what it shouldn't really be the question that you're asking on the call. You should have answered for yourself, like going into a VC pitch and saying, hey, what areas do you invest in, and what the size of your fund is. That's something you should have kind of figured out already. And honestly, it kind of looks bad if you don't have that information, if you're asking those questions that you could have found already. It just looks like you haven't done your research. But yeah, the typical VC call, I'm sure you guys go over pitches, but it's usually a 10-minute pitch followed by, Q&A to their heart's content. But you should have, in your pitch, really like explain the problem, explain your, your solution, explain the potential for the market. That's kind of the broad strokes. And then there's a pretty standard format of, what a deck should look like. You should emulate that, because when I see a deck that's just kind of all over the place, it just shows me that they're just not ready for, prime time yet. But there's so many resources on what the typical, pitch should look like.
Yeah, just slight follow up on that. I'm sure, I don't want to get advice just for my questions, but just keeping it on the broader terms, it's like, especially a lot of the times, the problem or the solution is more market specific or the technology specific, right? And if someone doesn't understand that too much, then there's we as a company have pitched to more than probably 5-6 VCs at this point, and each VC we have gotten a different reaction, because someone who understands the market and the space better has different feel for it as compared to someone who has not. So we kind of try to tailor it to beforehand, but I want to know if you have any general thoughts on that.
Yeah, so I'll answer that 2 ways. So number one is, you should always, I think the best way to approach that is start basic, and then just say, if this is too basic for you, I'll skip ahead. Or how familiar are you with, DNA storage space? And if they say not at all, you kind of give them the explain it to your 8-year-old version. But if they are, if they're a frontier tech company and they are aware of it, you can skip ahead. So you sort of just kind of understand where your audience's knowledge is. You could be talking to an associate that doesn't have background, or you could talking to someone that does. So sort of start low and say, look, if this too broad, I can skip ahead if you're familiar with the space. And if they say, no, I'd like to know, then give them sort of the general, background. That is a problem, because a lot of these agnostic firms, don't have a healthcare background. So if you're pitching a healthcare deal, you really have to kind of bring them up the curve a little bit in that time, and that's incumbent on the entrepreneur to do. One thing I would say, it's just got overall, this applies to everyone, and this is really important in venture. And this is probably what will get you funding and what won't get you funding, or at least the next call, is kind of put yourself in the VC's shoes and just say, and you could do this through practice, rounds with other people, when you give your pitch, the most important thing to do is sort of answer or address their concerns before they come up. So they don't, when they leave the pitch, they don't say, oh, that's a concern. So like a good example would be, you know, you have a super, you know, you have a crazy computer background, you're building this tech company, and they come away thinking, I wonder if they have kind of the business acumen to kind of make this work as a business. So you know where your shortcomings are. So you sort of just subtly address them in the pitch. Just say, hey, here's my background. By the way, I ran this business. I have this, you know, I have a business background here. My CEO is, you know, a COO has run 4 businesses. If they're worried about kind of market size, you dig in, you really say, look, I know you've never heard of this cottage industry of, children's sleepwear, but here are all the facts, and just really kind of drill into their head so they don't come away thinking, oh, is that really a big enough market? So just kind of think about where you think anyone that's seeing this business for the first time is going to go, is like, oh, this is why I won't invest, and sort of answer that for them before they have the ability to kind of think of, oh, this is a negative. And the way you do that is really pitch it to 6 or 7 people. And then when they come back to you and say, oh, I didn't like it for this, you sort of just kind of put that into your pitch to kind of assuage their fears before they have them. And that's important. It's always important to get kind of feedback from everyone you pitch. VCs say like, hey, why did you pass? I'd love to know. And they'll give it to you. You might have to follow up twice, but you should be getting that from people.
Thanks, Brian. Really appreciate it.
Sure.
All right, I'm going to move it over to Julie. Go for it, Julie.
Hi, Brian.
Hey, Julie.
Congratulations on raising your fund.
Thank you.
I know you had a lot of success as an angel investor before raising the fund, but I'm wondering if you have any advice for first-time fund managers that are interested in raising right now.
Yeah, so I was very lucky that I didn't have to do that. I kind of went to one family office, so I have like a single LP backing it. I didn't have to do the roadshow, but I can give you sort of it's a long slog. I've talked to 4 people recently that have raised funds, and one was at EIR at a Kleiner Perkins. And they seeded him, $5 million, and he wanted to raise a $50 million fund, and he got one strategic, and then it just sort of stopped, and it was just like going family off. So I'll give you, I know another person that had a hardware accelerator, and he's like, I'm going to switch to a fund model, and just couldn't get the traction there. It's hard to raise money, and it's hard for a first-time founder to raise money, or a first-time fund. What I've gotten just from advice that I've heard is you need to set yourself apart. So there's so many industry agnostic funds. What makes you different? So I guess the key to the pitch is you want them to come away saying, what makes this fund different? Why are they different? Having access to deal flow from top VCs is not really enough to move the needle. Everyone now in their pitch deck says, hey, I'm here's my channels, I'm getting channels from these people. I don't think that's enough. Having a good entrepreneur network is certainly helpful, but a lot of people have that. But really kind of if you can show why yours is bigger or different than someone else's. Again, I always find it good to put yourself in the other person's shoes, and the other person is going to say, I have a ton of money to invest. Why is this person going to make me look good? And if your answer is, I'm hyper-focused on the IoT space, I have a background there, no one is doing this. Like, oh, that's different. I don't have IoT in my portfolio, so that's good. You have a deep tech understanding based on your time at SpaceX, and you want to do a space fund, that's different too. So I think having a specific vertical is better for a first time fund to focus there. Another thing is to kind of have a track record and say, hey, I've made these angel investments, I've made these investments here, this is why it's worked. I'm showing that I'm obviously competent at this. What else? It's weird. It's like the smaller funds, it's harder to raise because a lot of institutional money just has to write bigger checks, and they just can't a $5 million check is going to move the needle when they have to invest, $500 million a year.
Yeah. So given that, who do you recommend targeting? Family offices?
Oh boy, so family offices, I would say no. They are so, and look, I'm saying no, but you should talk to if other people might say yes. I know some people that manage family offices. I know some private equity folks that sort of raise. Family offices are just so anti-blind pools right now. They don't want to give money to. They want to have some decision making. So if you are talking to a family office, I think the only way it would work, and I don't know if this is possible, is you say, look, we're a Series B fund. We're writing, $200,000 checks. The reason why these people are letting us write smaller checks is because they want our, expertise, because I have this expertise, or I have this board of advisor. I have something that's going to add value to them. But with that, we're also going to have sort of a pro rata where we will allow co-investment. Co-investment's a big term right now, right? So a lot of funds have, you can co-invest, but it's a 5% fee. You could say, look, we're going to have a lot of co-investment opportunities for free, and that might sort of whet their appetite a little bit. I was thinking that is sort of like a differentiator to a fund. But no, blind pools they're just really not into right now, and they're either managing their own decision making. They want to have their own decisions in the fund. So, man, I know a lot of people that took a lot of time talking to a lot of family offices, and they just said it's a slog. And these are people who are really well connected, that have told me that, and they had foots in the door of all these places, and it's a lot. It's a low hit rate to the family offices.
Thank you.
Yeah.
Great. Thanks, Julie. I'm going to go to Tom.
Awesome. Hey, Brian, thank you for being with us today and talking through all the stuff with us. So my name's Tom. I'm with Roman Aerospace. We make software that sits on drones and helps them fly farther, better, a few different ways. So my question is about if you're solving, in a sense, more than one problem. So if you have a technology that solves one problem in the short term and a slightly different problem in the longer term, it always feels like you have to frame things such as, we're solving this one single exact problem as a startup. But if your technology and your kind of market plan covers a shorter term problem than a larger, longer term problem, how do you phrase that in a way that makes sense and tells the right story and kind of catches the VC's attention?
Yeah, I mean, that's a great story. I mean, the key term is always a beachhead, right? And it's like, what's our beachhead market? And then how can we, once we have this, how does having that beachhead make phase two more likely, right? So it's like, hey, we're solving this term, we're getting our foot in the door with these customers, and then once we're in the door with these customers for this, we can start selling them this bigger, and more ambitious project. I think the ambitious project is really what's going to, ultimately sell your round. So you have to have that kind of well thought out. But the other thing, and besides just kind of here's my beachhead, here's how I'm doing this, you also really have to explain that sort of transition piece of how you're going to go from A to B, and why it makes sense that you're starting here, and how that is going to help you into the more ambitious market. So not only kind of the bigger picture, but how the path there is defined, is how I would kind of pitch it to people.
That makes sense. And so on the slide where you say, here's our solution, or like, here's the problem we're solving, do you ever say the problem is short-term this, long-term this? Try to indicate that on there.
I've seen it both ways. I've seen it where I've been pitched this grand vision, and then I'm pitched, and here's how we're getting in there, right? I've also been pitched, here's the small business we have, and then, by the way, here's where we're going in 3 years. I've seen both of them work. I think it's really your audience. So if you're pitching a Tim Draper, or I think a lot of these larger firms have sort of like scout funds, or even like a Y Combinator. You might want to lead with sort of like the bigger vision, so because they're they're unicorn hunting, right? And they want to see that first, and then they want to see kind of the beachhead. If you're pitching to a seed fund, angels, you might want to pitch the earlier market, so they say, oh look, I get this, they can do this for sure. Even if they don't get to part B, I'm going to get out with, they can sell it for a 2-3x return. I'll take a double or triple. That's fine. So really know your audience and kind of what they look for. And the way you do that is you look in their, you look at their investments and kind of see what they are. And, if they're, they have a lot of unicorns in their name, that's great. They have a lot of small acquisitions to Google. Maybe they're more interested in that. They're more familiar with that. Really know your audience. But I would say the bigger the name, the more you should sort of tip the scale to the bigger picture.
Cool. That makes sense. We've talked actually a little bit with Draper Labs about licensing some tech from them. It's funny you mentioned that, but Brian, very much appreciate the thoughts.
Good question, Tom, as always. We're so proud of you guys, as a VSG team. Elisa, I think that's how you say that. Elisa, go for it.
Hi there. I can start my video also if you give me permission.
Yeah, sure. I mean, do you not have permission? Oh, here. There you go.
Hey, Brian and everyone. Thanks, Brian, for doing this, Araceli, for hosting. I've already taken some notes and real gems you're dropping, so thank you. I'm a founder and CEO of ArcVita. We do tech-enabled career guidance for U.S. professionals, revenue generating, ready to go. We've got a solid team and we opened our first round in January. We're about 30% in. So my question is about the how. Does Tech Coast Angels, either the fund or individual angels, invest only in a certain way? We've been advised to use a SAFE so we don't get in, just for everybody else, I've gotten deep into this. Basically, at an early stage, convertible debt comes with covenants. So it adds a bunch of legal costs and also requirements as a business that get expensive to manage. And all the investors are just wanting to get in on the upside. So that's my tangent on what I've learned. So
sure.
Question to you, Brian, how? And is a SAFE problematic at all for your group, either angels or as a fund?
So the short answer is no. Only there are two safes. There's sort of the early safe, which is the pre-money versus the post-money safe. Y Combinator kind of came up with this and they didn't anticipate sort of follow-on rounds on the same safe and the dilutionary effects it would have. So they have sort of like a round 2 safe that they use. So that would be the only, if you're looking at a safe, make sure you're using the newest model that they put out. And I think most people are now, but familiarize yourself with the difference there. From our standpoint, convertible versus safe versus price round, we couldn't care less for the fund. I couldn't care less for ladder ventures. I think I speak for most VCs out there where it doesn't matter at the seed stage. Equity is always slightly better just because it's just more protective for the investor. But I recognize it's a large cost, and most companies now don't kind of convert to equity until the Series A. From an angel standpoint, a lot of people want, and I say a lot, I'd say probably 30 to 40% of our members would rather have a price round, just for 2 reasons. One is, it's just the protective effects, and they might have been burnt before. But 2 is there's a tax with the Jobs Act. I don't know if you're familiar, but there's like a tax incentive, or I'll give you a quick background. There's no taxes on capital gains in startup investing, but the only issue there is you have to be invested for 5 years. So to invest in a priced round, it starts the clock earlier for a potential exit to potentially get a tax-free return. So some people look at that and say, I'd rather have a priced round. I don't think it's going to make too much of a difference for you. If you go in with a safe, that's fine. You might get a investor who says, look, I want to give you $1 million, but I want to do it on a convertible note, or I want to do a price round. And the answer is like, yeah, we'll do it. So really,
Started I started my career in investor relations. So for $1 million, we'll talk differently. For
Yeah.
5 grand, 20 grand, no.
Yeah, no, and I think that's reasonable. I don't think you should, in general, any besides just the note you take, but like the valuation, any other sort of pro ratas, whatever. Don't change kind of what you have for a small check, but be aware that if there's a lead investor that wants to do something, then that's when you should, be flexible in changing it. I don't, the only thing that there are some funds that won't invest in LLCs, and the rationale there is for tax reasons from their standpoint. So with an LLC, it's possible to incur, like I guess a tax liability before you get any profits. So that puts the fund in a weird position because now they have a tax bill, but they don't have any money to pay for it, right? They can't pay with investors' money. So some funds say we won't invest in LLCs at all because of that potential tax issue. It's so rare where you get like, but it does happen sometimes. So that's the only thing I would kind of be aware of, that you might have some people that say, hey, my fund just literally can't do this, because what they would have to do is they'd have to pass that tax liability on to LPs, and LPs are like, I don't want to do that. So that's like one minor issue.
Yeah, and we are Delaware C. For those of you who haven't incorporated yet, I talked to 4 tax attorneys before I came down to this answer, which is it's just a lot easier to get investors if you're a tech scale venture kind of company, if you're Delaware C. So Brian, thank you so much. Happy to connect with you later. And everyone, happy to help. My background's in finance. If you're struggling with your model, reach out.
Wow, thanks, Elisa. What a great offer. I hope everyone got that. Next is David Gerber. Thank you for being so patient.
Brian, thanks very much. I actually had 3 quick questions, one of which, in a sense, you just answered, which was, again, I've been trying to understand whether or not safe or convertible, independent of what the investor wants. So that one was answered. But you mentioned something earlier about deck templates, and I wanted to just ask you, of the deck templates that are out there, what are the ones that you actually find to be most successful?
I mean, we have one on our website. If you go to techcoastangels.com, you can download a template, and it really just shows you sort of the order of how we like to see things. It's pretty standard. I don't really know of any other, I mean, I'm sure there's 9,000 different templates.
Yeah, there's tons.
But really, I wouldn't, like the formatting and stuff like that, don't get too caught up in, but maybe the order and like the total amount of information that's out there. That's really what I'd focus more on from the template standpoint, is like, are you hitting on all the things that are in the template? And if you change the order of your story, yeah.
Third question, and then I will cede my time. You talk about beachhead market, and this goes back to sort of the Thomas question. I'm involved in a startup which is about a SaaS business for sustainability, and it's a really complicated beast. We are doing lots of things. We have an AI layer, et cetera, but the AI layer isn't really generating revenue now. We're having to actually create a set of tools in order to get to the longer term project. And you talked about, in a sense, the transition piece. And I think quite candidly, this is where we struggle, because we're talking about the big vision, the big market opportunity, the switch to ESG investing, all of the macro trends. And then we go back down to, well, we have this road mapping AI tool, and then we have this AI tool and that AI tool. And sometimes I feel like we're not knitting it together. And I would love any advice you have in terms of how we should be telling that story in a way that's really palatable, especially to seed.
Yeah, I mean, it's tough to give specifics without knowing kind of, the exact intricacies of the business. But what I would say in general is just sort of sit back and sort of, meditate, think about how, if everything goes right with your business, you get a seed company, you go after the beachhead market, it's going well, you get some more money in the door, how you would then transition it to sort of the end goal, and think about that time period, and how having a beachhead market makes it easier than if you just launched right there, right? So just think about the advantages that being in the beachhead market has given you for this current stage. Basically, put yourself, pretend like your present moment is that sort of transition. Right? So right now it's 2022. You know, the beachhead went great. You're raising money. Now think about like, oh, I'm so glad we did this beachhead market because that allows us to do A, B, and C. That allows us, like, we already have customers that we can now expand upon. We've already built a technology and have a tech stack in place that we can just add to. We already have IP in place that we can now, utilize. We already have grants that we've applied for that have a 5-year, shelf life that we can keep going back on. Whatever it is that's specific to your business, think about like, if the present is 20, 23, 22, whatever, what takeaways do I have from my the earlier sort of iteration of the business that will allow me to transition into.
Thank you very much, Brian, and nice to meet you.
Yeah, thanks.
Great. Okay, I'm moving over to Armando.
Hey Brian, how's it going?
Hey Armando.
Hey, I just had a question. I wanted to hear your thoughts on kind of the audio space. Kind of recently, we're starting a startup in the Napa Valley based on the audio space, and recently I've seen Amazon just acquiring Wonderly and Twitter buying this podcast platform called Breaker, and then Clubhouse, launching in the past couple months. And just kind of from a VC perspective, what do you think of that and where it's headed?
So it really depends on where you are in the audio space. I think music rights, songwriter rights, unless a VC is hyper familiar with that area, once they start scratching the surface and going down the rabbit hole of all of the legal issues in that market, they just, they get freaked out. So, I know a lot of successful companies. God, there was a company at Amplify that, great founder, ended up great exit, but they just had a lot of trouble. They were monetizing basically SoundCloud. I can't think of the name of it, but super smart founder. And the people that his investors were basically people that got it. And he just, it was hard because if you weren't in the space, it's tough to kind of get people to get through all of that stuff. So if from the music standpoint, that's challenging. And I would say don't waste your time on sort of an agnostic VC because they're not around it. I would look, what I would do if I was you is look for not competing companies, but companies you respect that have done well in the audio space, that are not competition, but in parallel enough spaces that if you went to, and then you look at Crunchbase or Deal, I don't know if you guys have DealBook at Viterbi, but and look to see who their investors were, and then go to them and say, hey, look, I know you're an investor in so-and-so. We have this company that does this. I'd love to chat. That always opens doors versus just like a cold email. And it will help you as well because they already have come up the learning curve and have sort of, gotten past the dragon that is, the music rights and audio, space issues. So, and that's just general, like for anyone really that isn't in an easy, product to understand. Look for kind of similar companies out there that you would think that, oh, an investor that understands, Slack, well, Slack's pretty easy, but like an investor that would understand, XYZ would probably understand my market too. And sort of focus your efforts on that.
Sweet. Thanks, Brian. Appreciate it.
All right, moving on to what looks like our final raised hand, Julian.
Hey.
Good to see you again.
Yeah. Hope the move went well. I think it was start of December when we chatted, right?
Yeah, lots changed.
Yeah. I hope you're well. Yeah. Main updates for you is we raised about $500,000 after we met you.
Yeah.
Which went well, and we moved forward with. So we've got enough money to like start 2022. But I wanted to, but I appreciate your feedback, and it was super cool. Yeah, I want to just because I didn't realize you also had the ladder venture side, because when we were chatting, I didn't realize that was another bit, and your insights been pretty amazing from that point, from looking at it from that point of view. But I think part of the success that we've had is, and I want to get your thoughts on this, is obviously there's the money side, which you're incredible feedback on. But the reason I think we've accelerated quite a bit is because of the guidance side and that ability to accelerate us. So like one of the VSG mentors, for instance, because we're doing a lot of stuff in the telco space, we've kind of got to 7 of the telcos because of him. And I wanted to, how does this founder assess, because for us, there's money out there, but we want guidance to accelerate us. And I wanted to get kind of your feedback on that, like how to assess it outside of portfolio, looking at, complementary portfolios to what you're doing. The people and whether their ability to accelerate you to get to that next value that you discussed, like how would you go about it if you were us?
So are you asking, I think you're asking one or two questions is as I'm looking at, are you looking at like advisors or investors to kind of get you to the next level, or both?
Well, an investor who can also accelerate through network versus just investor money in of itself. So yes, so like, how would you go about assessing that outside of just looking at the portfolio of that? All right, we do audio. They have an audio company, great, right? Doesn't mean they've got a network in audio, right?
Yeah.
Those people, right? So it's yeah. How would you go around doing that? Because that's obviously a big thing for us, right? Like is acceleration, right? So.
Well, I think, look, I mean, I always say it's great to have choices of investors beating down your door and saying, hey, you're going to have the most value. I'm going to let you invest in me. For 99 out of 100 companies, it's like, hey, you have money, that's fine. And then, any value added is sort of a bonus. So from that standpoint, if you're in the enviable position where you can choose your investors, I'll answer the question to that. But also you might get into a situation where you have, personally, hey, look, I want to invest in you, but I can make a lot of introductions and I want warrants or somehow a lower valuation than anyone else is getting. So that, my advice will be to that. And also for like those that are thinking of signing on advisors where you're giving them equity and to kind of suss out like, all right, is this person for real or not? So from the advisor standpoint, if you're thinking of signing on someone for an advisor, I would always kind of say, look, can you give me some other companies that you've helped advise and maybe do kind of a background check on them? The other thing with advisors is, and this is one thing that people don't do enough or entrepreneurs don't do enough, is they are fireable. You can fire advisors. You can say, look, you're vesting every month. Thanks. Take the 3 months of this, 0.5% you have, but like it's not working out. If I'm ever advising a company, I say, look, let's just do it for 2 months for free. Let's not worry about anything. And then in 2 months, we'll circle back. And if you actually want to keep doing this, we'll put something to paper. If it doesn't work out, like we'll go our separate ways. That's fine. But yeah, like a lot of companies out there, they have this advisory board that's just sitting there. It's dead money, and they should just kind of get rid of it. So be quick to cut ties if it's not working out. And then also, what else was I going to say about advisors? Don't just have big names as an advisory board. I just don't think it really helps unless you have, even if you have like a hyper strong name on there, they're usually not doing a lot of work. So there's like this inverse relationship to like how far along they are in their career versus how much work they do. So you might find, a younger person in the industry will actually, a first-time advisor, second-time advisor will do a lot more to advance your company than, an ex-CEO of some industry that just kind of will say yes. So, and a lot of investors, like now when we're looking at advisory board as investors, we say, all right, you have this name up there. Can you explain your sort of, relationship with them? What have they done for you? And if they say nothing, then we're just like, well, why is it even up there? So from your standpoint, again, if you have the ability to choose, that's great. How do you assess whether a VC has actually made connections? Look, you can always ask them, hey, is it okay if I reach out to one of your portfolio companies to see what you've done? You can always kind of reach out to them yourself, and do it. That's done as well. Just kind of do your own, or just ask them outright. Say, hey, how have you? I see that this company is on here. What have you guys done for them? What interest have you made to kind of help them along the line? But again, really be careful, because you don't, if it is a situation where you have 3 term sheets in front of you and you're choosing, then you can say, hey, look, I want to choose you, but I just want to see, what you've done in the past. You mind if I, call a couple of your people? Or can you tell me what you've done? Or yeah, I'd love to give you the warrants, but I need to know more about, exactly how you're going to accelerate this business. And then, go from there. But it's not like an easy thing. I would say you got to ask, and you got to do your background checks. Yeah.
Awesome. All right. Thank you, Brian.
Sure.
All right. Well, I want to be sensitive to time for Brian's sake. We do have another hand raised. Brian, can you handle another question?
Yeah, I can do one more. Sure.
Yeah. Okay. So George, go for it.
Yeah, thank you so much. Sorry for the last minute, kind of came in the end. Hi, Brian. Thank you for your time. I'm Jorge. I'm a machine learning engineer with a kind of focus on sustainability. So my question goes into how's the acceptance on VCs in terms of like having other regions as their target markets. Let's say Latin America has got like a good impact last couple of years. So I don't know how it's the kind of the reaction, or like how VCs react when you're aiming for other market. You think it's a good strategy to aim for a VC in the US before, or like an angel round in the US, even though you're aiming for a Latin American market, or how you feel is there in that aspect?
So are you, I'm just trying to understand the question. Are you saying from an entrepreneur standpoint, should you aim for VCs locally, even if you're going after a LATAM market, or if you?
No, I think I would say like more like the general acceptance of VC, like how much willing is a VC to invest in a startup, let's say in an angel or seed round, considering that the target market is not in the US? Like how much they feel comfortable about it so far?
Yeah, I mean, it really depends on the VC. I don't think, if it's their first foray into sort of a foreign country, it's a little bit more, they're probably going to dig a little bit deeper. So I would probably look for VCs that have invested in, companies down in, in that area that are kind of focusing on that market. So here's the thing. A lot of VCs, they have to, well, not a lot, all VCs, they're an LLC, they have to have an operating statement, and their LPs sign off. And if they say, we are investing in US markets, they cannot invest in you. So they'll tell you right out, like, look, we're US focused. And it's not, I don't like you. It's like, look, we signed a document with our LPs, we can't invest outside the US. So that's something you could probably get an answer to really quickly. Just kind of approach them. But you could also see some startups that are operating down there that and see what VCs have invested in them, and just approach them and say, hey, look, I see you're an early investor in Mercado Libre, and we're approaching this market, and it's something you'd be interested in. That would be kind of my advice, is really just kind of see what their portfolio is. It's definitely the area people are focusing on, but there's just a lot of VCs that are like, I just can't do it.
Yeah.
My family offices, I said I'd be focusing on the US. It does close your doors a little bit, but it actually helps, because I was just on a presentation today. It was like VCs. I think there's like 7,000 VCs just in the SoCal area, like Southern California alone. So the fact that you can now sort of, break it down to maybe 10% of them are focusing in Latin America, you're actually in an advantage, because they probably don't see a lot of companies they're pitching in Latin America that are in the area. So, you find, it's just kind of like anything. You find your target market, and you're sort of differentiating yourself from everything else out there. So you might actually find it easier than someone that that has a company that's running only in the US, because they have so many VCs to choose from, and those VCs have so many companies to choose from. So, you know, it could actually work out better that way. But I don't know, like, there's no like Google search to do it. It's like word of mouth of, hey, who's investing in LATAM? I don't know any off the top of my head, because I don't invest in LATAM, so I don't know. But the best way to do it was find a couple startups that were successful down there, or international startups, and then just kind of follow the chain to see who's invested in them.
Okay, thanks. Yeah, it was kind of like more general trust if it has some different perspective of having a business over there, but it makes sense for you that depending on your business, you will invest or not. So thanks.
Sure.
All right, well, we're coming up at time, well, over time. I just want to say very quickly thank you to Brian for spending this time with us and helping us out and answering our questions. It was very lively Q&A. For the record, Brian. Usually it's more of like a, not a dry presentation, but like a standalone presentation. So obviously people have plenty more questions, I bet. So we can get you on the line sometime down later this year. It would be great. I want to just let everyone who's still on know that I will be sending out the video of this chat along with the actual transcript of everybody who's networked in the chat section, so you guys can kind of review that later. And then Brian, maybe you and I can connect and talk a little bit about the screenings, so that I can maybe include some of that information in my wrap-up email to all the participants, in case anyone here is really interested in sitting in on one of those screenings. And VSG would love to host another one, even though it wouldn't be in space in the arena, but maybe some way virtually we can involve ourselves, because I know they're really useful.
Yeah, I'd love to get back there once we're live again. Once we all.
I know, right? Well, anyways, do you have like any like final words and like a parting piece of advice, that something that like everyone could use, or?
Look, there's a lot of money that's being printed out there that's looking for a home. From a institutional standpoint, equity markets are way up, and they're looking to deploy into alternative investments more and more. It's the best time to be an entrepreneur right now. You have capital fighting for you now. There's a lot of new VCs starting up, a lot of older VCs raising new funds. It's a wash with capital. So you guys are coming at the best time, I think, in the last 20 years to be starting a business. So I'm looking forward to seeing where it takes us.
Awesome. That's great advice. It's not oftentimes that entrepreneurs hear that they're doing the right thing at the right time. All right. Well, thanks everybody. And you'll hear more about the.
Thank you, Brian.
Bye.
Cheers.
Thank you.
Stay safe.
Same.